In the world of investing, there are periods of bullish enthusiasm where markets soar, and then there are times when the bears come out to play. A bear market is characterized by a sustained downturn in stock prices, often accompanied by pessimism and widespread selling. While these periods can be daunting for investors, they also present opportunities for those who are prepared and resilient. In this comprehensive guide, we'll delve deeper into what it means to survive a bear market and offer practical tips to help investors navigate through the storm. Understanding the bear. Before diving into survival strategies, it's crucial to understand what causes a bear market. These downturns can be triggered by various factors, including economic slowdowns, geopolitical tensions, or changes in market sentiment. When investors anticipate negative future economic conditions, they start selling off their investments, leading to a downward spiral in prices. A classic example of a bear market occurred during the global financial crisis of 2008. Triggered by the collapse of the subprime mortgage market in the United States, the crisis sent shockwaves throughout the global economy, resulting in a prolonged period of market decline and widespread panic among investors. Tip 1. Stay calm and stay informed. The first rule of surviving a bear market is to keep a cool head. It's easy to get swept up in the panic and make rash decisions, but reacting emotionally can often lead to poor investment choices. Instead, focus on staying informed about what's happening in the market. Keep up with financial news, read analyses from reputable sources, and consult with trusted advisors if needed. By staying informed, you'll be better equipped to make rational decisions based on facts rather than fear. Imagine you're an investor who wakes up to news of a steep drop in the stock market. Your initial reaction might be one of panic, but instead of immediately selling off all your investments, you take a deep breath and start researching the reasons behind the downturn. As you read more about the economic factors at play, you realize that this could be a temporary setback rather than a long-term crisis. Armed with this knowledge, you resist the urge to sell and decide to wait for more clarity before taking any action. Tip 2. Diversify your portfolio. One of the most effective ways to weather a bear market is to diversify your investment portfolio. Instead of putting all your eggs in one basket, spread your investments across different asset classes such as stocks, bonds, real estate, and commodities. Diversification helps reduce the impact of market volatility on your overall portfolio performance. When one asset class is experiencing a downturn, others may be performing better, helping to offset potential losses. Let's say you have a diversified investment portfolio that includes stocks, bonds, real estate, and commodities. During a bear market, while the stock market is taking a hit, the value of your bond holdings remains relatively stable. Additionally, your real estate investments continue to generate rental income, providing a source of cash flow even in challenging economic times. As a result, the impact of the bear market on your overall portfolio is less severe compared to someone who has all their investments concentrated in stocks. Tip 3. Have a long-term perspective. In the midst of a bear market, it's easy to lose sight of the bigger picture. However, it's essential to remember that the stock market has historically recovered from downturns and gone on to reach new highs. Taking a long-term perspective can help investors ride out the storm without succumbing to short-term panic. Instead of focusing on day-to-day fluctuations, think about your investment goals and the time horizon over which you expect to achieve them. Consider an investor who had been diligently saving for retirement and had invested in the stock market for the long term. When a bear market hits and the value of their portfolio starts to decline, they resist the temptation to sell based on short-term fluctuations. Instead, they remind themselves of their long-term goal of building a nest egg for retirement. By staying invested and continuing to contribute to their retirement accounts during the downturn, they are able to take advantage of lower prices and position themselves for future growth when the market eventually rebounds. Tip 4. Keep cash on hand. While it's essential to stay invested during a bear market, having some cash on hand can provide a buffer against unexpected expenses or opportunities that may arise. Maintaining a cash reserve allows you to cover your living expenses without having to sell off investments at depressed prices. It also provides the flexibility to take advantage of buying opportunities that may emerge when prices are low. Imagine you're an investor who has set aside a portion of your portfolio in cash. During a bear market, while the value of your investments is declining, you have peace of mind knowing that you have enough cash on hand to cover your living expenses for an extended period. This allows you to ride out the downturn without having to make any forced selling decisions. Additionally, when you spot attractive investment opportunities amidst the market turmoil, you have the liquidity to capitalize on them and potentially generate higher returns in the long run. Tip 5. Continuously review and rebalance your portfolio. In times of market volatility, it's essential to regularly review and rebalance your investment portfolio to ensure it remains aligned with your financial goals and risk tolerance. Rebalancing involves selling assets that have appreciated in value and reallocating the proceeds to assets that may be undervalued or have underperformed. This disciplined approach helps investors maintain a diversified portfolio and capitalize on market opportunities as they arise. Consider an investor who has a target asset allocation of 60% stocks and 40% bonds. During a bear market, the value of their stock holdings declines significantly, causing their portfolio to become overweight in bonds. To rebalance their portfolio back to its target allocation, they sell some of their bond holdings and use the proceeds to purchase additional stocks at lower prices. This not only helps restore the desired balance between stocks and bonds, but also positions the portfolio for potential growth when the market rebounds. So to wrap up, surviving a bear market requires patience, discipline, and a willingness to stay the course despite short-term fluctuations. By staying informed, diversifying your portfolio, maintaining a long-term perspective, keeping cash on hand, and regularly reviewing and rebalancing your investments, you can navigate through the storm and emerge stronger on the other side. Remember, while bear markets can be challenging, they also present opportunities for savvy investors to capitalize on lower prices and position themselves for future growth. So stay calm, stay focused, and stay invested for the long haul. With the right strategies and mindset, you can weather any market downturn and come out ahead in the end. See you in the next video, and happy investing.